Hello, you're welcome to this live session. If you can hear me, let me know in the comment section. Kindly type you can hear me in the comment section. Hello guys, so if you can hear me, kindly write it in the comment section so that we can start. I don't want to be talking while you guys are not hearing me. Okay, so now this live session is about daily bias and how we can easily identify the bias in the market. And the first thing you need to do every day is to look at the direction of the market, where the market is likely to go. Is it going to go bullish or bearish before you take any decision in the market? And mostly for me, if I should start by looking at which pair I will trade, what I do every day is that I check the dollar index, because the dollar index is the driver of the foreign currencies. You will see that when dollar is bullish, the foreign currencies are bearish, so they are opposite correlated, so they are not going in the same direction. So that is why when you have the direction on the dollar, it's easy for you to also have the direction on the foreign currencies. So let's start by looking at the dollar index. Now here we are on the dollar index, and we'll start by looking at the weekly time frame. You see, the reason why you have to look at the weekly time frame is for you to determine the direction of the weekly candle. Where is the weekly candle going to go, and which direction will it follow? Now this is because the weekly time frame follows the order flow direction, and you have to also use the weekly to identify draw on liquidity, where price will be drawn to, so that you can trade in line with the institution in the market. Now this is the weekly time frame, and to analyze the weekly time frame is very, very simple. Now the first thing you have to look at is internal external range liquidity. You use this method to identify the direction of the market. So you can use internal range liquidity to external, or external range liquidity to internal range liquidity. So this concept will help you identify the likely direction of the market. Now, you can use the internal to external range liquidity or external to internal range liquidity to identify the direction, as well as you can also use the market structure to identify the direction. But for me, it is easy for me to use the internal to external range to identify the direction of the market. Now, the second thing is that you have to also look out for reactions. Now, we're talking about the weekly time frame. You also have to look for candle reactions in the market. What is the candles doing? Because the candles tells us a lot of story of what is really happening between buyers and sellers in the market. So you have to look at candle reaction, candlestick reaction, and the weekly time frame. So you have to look out for candlestick reaction. Where is a particular candle reacting up from? Now, the next thing is you're going to look out for swing points in the market. And when I say swing points, I mean swing high and swing low swing points. So these are the three things I usually look out for on the weekly time frame to also determine my weekly direction. So now, if you look at, for you to use the internal to external range liquidity, you have to look out for the current price. You have to look out for the current price in the market. And this current price is anything between this leg in the market. These are the current price leg. So you have to also look out for the internal and external range liquidity at the price leg. Now, the first thing you have to consider is where is the market coming from? And when we see the price is coming from an internal range liquidity, and we see price coming from this internal range liquidity here. So we're expecting to see price taking out external range liquidity, and we see price has taken out this external range liquidity. So and now we'll be seeking internal range liquidity, but remember I told us that we have to also look at the candlestick reaction. When price took out this external range liquidity, let me increase the size. When price take out this external range liquidity, we have price reacting at this level. We see price reaction. Now this candle here is telling us a lot of story. And where is candle reacting from? The candle is reacting from this change in the state of delivery. Now because we have this opposing candle, the price has closed above. So we have this change in the state of delivery, and price is reacting off from the mid threshold. So if you put your rectangle line tool, you'll see that price is reacting off the mid threshold. So as soon as you see candle reaction, you have to start observing what the bodies of the candles are doing at that particular level. The first thing you have to look out for is when the price starts reacting, do we have a likelihood of swing points? And that brought us to the 3 points we have here. We see when price reacted, we see price close inside the previous candle range. Now, where is the previous candle range? We have this. Let me mark it bold so that we can see it. And let me change the color to be red. Okay, we see this candle close inside the previous range. And now the range is from this low to this high. Now, what do we have? We have what we call a likelihood of swing formation. So when you see this, you should anticipate a swing formation. Now, this is not what you use to anticipate swing formation. I'm going to show you later in this video how you can anticipate a swing formation. But what I want to tell you is that now we have a likelihood of swing formation, and this is what we call the swing low. So you can name this one as candle 1, this black candle as candle 1, and then the other candle that formed the swing formation as candle 2. So we can have this as candle 1, then we can have this as candle 2. So now between candle 1 and candle 2, this is where you have to determine if price is going to reverse. Now, candle 1 should give you the range, and then candle 2 should close inside the range, knowing that the candle 2 is reacting off a particular level. So now what you're going to do is to go to the 4 hours time frame and spot your market structure shift for you to know that price is willing to now start retracing. But I'm going to show you this later. So now seeing this, we see the next candle is bullish. Now this is what we call candle 3. You can name this as candle 3 because the swing points are 3 candle pattern, either swing high or swing low. They're all swing point, and they are called three candle patterns. So now we have candle 1, candle 2, candle 3, which form the swing. Now as soon as candle 2 close above candle 2, as soon as candle 3 close above candle 2, now you know that price is likely to go bullish. Why? Because price has shown a what? A level of what? A level of reversal. Now, swing points at an institutional reference point or at point of interest, they serve as reversal. Now, candle closure above the previous candle serve as what? Continuation. Now, as soon as we see candle 3 close above candle 2, we should know that the next candle is going to be what? It's going to be bullish. And we see that the next candle was what? Was bullish, and price close above it. You see, price close above it. Now, the next candle, we see that price came back into an institutional reference point. Why? Because when candle 4, now we can name this as candle 4 as our continuation. When candle 4 close above candle 3, candle 4 attain a particular objective, and that objective is an institutional reference point. So we see candle 4 attaining a particular objective. Do you see that? So now the candle 4 has reached this particular up close candle, and on a lower time frame you see it as a fair value gap here. So now, and that is how we have this reaction coming lower. But now look at it. When price is coming into this fair value gap, because we have a fair value gap, let me remove this if this is understood. So if you remove this, you will know that when price was coming into the fair value gap, we see the same pattern happening at the fair value gap, because we have a fair value gap here. And what do we see? Price is respecting the fair value gap. Even though we see this retracement, price came into the open of this candle, of this bearish candle. So price retraced and then respected this fair value gap. Another point to consider is what? Is candle reaction. Because we are now at institutional reference point, and we are now at what? Internal range liquidity. We look at candle reaction and we look at swing points. Now we are at internal range liquidity, which is fair value gap here in form of imbalance, and we are looking at candle reaction. What do we see? Candle reacted. And then the next thing is swing point. Where is the swing point? We have our what? Candle 1. We have our candle 1 here. We have our candle 1. And we have our candle 2, which is this reacted candle. And then we have our candle 3. So, do you see it? So now we have on the weekly time frame, as soon as we see candle 1 and candle 2 appeared last week, we know that this week is going to be what? Candle 3, and candle 3 we are expecting what? Candle 3 to be bullish. So guys, this is how you can determine the direction now. You see the price is already what? Bullish. And where will be our what? Our drawn liquidity. This high will be our drawn liquidity, and then this high will be our what? Draw on liquidity. So you also have this high as our first draw on liquidity. So this particular level will be our what? Our draw on liquidity. So we know that the weekly direction is bullish. So now Going to the daily time frame. Now, after knowing the direction of the weekly time frame, you have to go to the daily time frame, because if you are a day trader, you have to take a trade daily. You have to what? Take a trade daily. Now, you have to go to the daily time frame. Let me remove this. You have to go to daily time frame and look at your trade on the daily time frame. So now, if you look at it, this is the level. This is the level price reacted from on the weekly. And then this week, we see this price reacting off this level. Now, how do we frame our trade on the daily? Last week, we see that on Thursday, Friday, Wednesday, Thursday, Friday, we see a swing formation. Do you see it? Now, how is this a swing formation? We see price has what? Has sweep liquidity below this low after the reaction. And then we have price what? Creating what? Candle 1, candle 2, and candle 3. And what do we have? Candle 3 close above candle 2. So now we have what? We have bullish continuation. So yesterday, Monday, I knew that price is going to be what? It's going to be bullish. Now, here is how to determine whether this swing point at this level is going to be bullish. And whenever you want to buy a reversal, or you want to involve in a reversal trade, because this is actually a reversal trade now, because we have price coming bearish and then price coming bullish. So price is in a reversal now. If you want to involve in this reversal, and at each reversal you will see a swing point created, which is a what? A swing low or a swing high. That is 3 candle pattern. What you need to do is to what? Is to go to 1 hour time frame now. Is to go to what? 1 hour time frame. If you go to the 1 hour time frame, you should spot for what? For change in the state of delivery. Now here, last week, Wednesday, Thursday, and Friday, price gave us this change in the state of delivery here. Let me remove this cycle. Price gave us this change in the state of delivery. Let me make it bold and clearer. So price gave us this change in the state of delivery because we see a sweep of liquidity below this low. And then we see this change in the state of delivery, which is this last candle that sweep liquidity below this low. And then we have price closing above it. Now we have a change in the state of delivery. Or you can mark this as your what? As your order block. So if you look at it, price close above it, giving us a market structure shift, and we have what we call an order block. So by seeing this at an institutional reference point, we know that price is going to be bullish. Again, if you look at it here, if I put in my indicator to mark my daily cycle, or to mark each day, you will see that this is what? This is Thursday, and price has given us this reversal. If you go back to the daily time frame, you will see that this is Thursday and this is what? Friday, and Friday closed above the daily candle of Thursday. So we're expecting Monday today to be bullish. So going back to our 1 hour, you will see that this is the high of Thursday. This is the high of Thursday, right? This is the high of Thursday, and we see price close above it. Now giving us a what? An indication that will be bullish on what? On Monday, because this is Friday, and Friday close above Thursday. So we know that price is going to be bullish. Now, how are you going to engage in a continuation? Now, if you are going to be trading Monday, you know that you'll be using Friday and Thursday to identify a range. Or basically, if you're going to be engaged in trading Monday, you're going to be using Friday to identify your trading range. Now, if you look at it, since we know that price has reversed and price is going to continue, given that Friday has closed above Thursday and Monday we're expecting to go bullish, you're going to be using Friday range. And this is the Friday range. Now, from this low, let me take out this indicator. It's making the chart crazy. So if from this low to this high is our candle, is our price range, because we see here that price has sweep liquidity below this level, which is sell side liquidity. And you see sell side liquidity has been grabbed, and we see a buy side liquidity has been grabbed. Then we have a price range. And what gives us the confirmation is that we see a level of what? A level of retracement. So we have this price range. So whenever you have a price range, ensure that you identify a point of interest at premium level or discount level. Now, if you are bullish, you're going to be identifying price level at discount level. And if you are premium, if you are selling, you're going to identify price level at premium level. Now, we are going to be bullish because we identify our buyers to be bullish. Now, what we need to do is to identify our daily range and point of interest at discount level. So here at discount level, we have this opposing candle, which is what? Change in the state of delivery. The second one is our fair value gap at discount level. You see it? It's at discount level because if we take our Fibonacci or price grading tool and then we grade it, you will see that price is at discount level. Those institutional level I marked is at discount level. Now, mind you, again, we are buying off an institutional reference point. Remember, this is a level we marked on the what? On the weekly time frame. So here we have this change in the state of delivery. We have a fair value gap. So if you want to be, at least perfect in your taking entry at price range, I want you to consider these three things. That is change in the state of delivery or order block. Also, you have to consider fair value gaps. Remember, at discount or premium. Then you have to also consider swing lows and swing highs. Swing low and swing highs. Remember, we are on 1 hour. So here you see, what do we have here? We have price coming into our change in the state of delivery. Now, when price came to the change in the state of delivery, you want to see price also creating a change in the state of delivery at that level, or you want to see price creating a protected low. Now, here we have seen that price has created a protected low and also create a change in the state of delivery at a change in the state of delivery within the 1 hour range. Now we see price of sweep liquidity here. And what do we see? At a level, we want to see candle reaction. What do we have here? We see price reacted at this level. You see it? And then price close above. We see price closing above this candle. Now we have what? We have a change in the state of delivery. Now this candle has become our change in the state of delivery. But we don't trade at this time because if you look at it, this is Asian session. Probably you might be asleep based on your time range or time zone, or you were doing something else. And also Asian is a low probability for this particular pair. That is for the dollar and foreign currencies. Is particularly low probability, or you can either engage in yen pairs, all these yen and and also pairs that are within the Asian session time. So here we see this is not our time of trading. So, but most importantly, we should know that this bullish move has started. But how do you involve in a trading session that is now intraday? Is for you to go to the 5 minutes time frame and identify a range in the 5 minutes time frame. Now here on the 5 minutes time frame, what do we see? We have our what? Our chart markup, and we see that this is the what? The Asian session, and this is the London. So if you want to engage in this price level, is for you to look at for what? For price range in the what? In the London session. And where is the price range? You have this from this low to this high. So you also look at for price range. And when you look at for price range, try and look at for what? For prices in the discount level. For me, particularly, I will take this trade. Why? Because I will have to look out for more confirmation, even though price did not come into discount. I will have to look out for more confirmation to buy. And if you look at it, price is reacting and creating swing point. As soon as this swing point price has closed, remember all what we said about swing point. As soon as price closes above this, I'll be buying. So now here, this is how we would have engaged in Monday. So now coming to today's trade, today's bias also. So if you're going to look out for today's bias, go to the daily time frame. So on the daily time frame, you have to look out for what is price likely to do. If you look at it, we've seen that price has what? Has closed above previous day high. So this is previous day high, and we see price has closed above it. So what are we expecting? We're expecting some bullishness. And what do we have? We have a draw on liquidity above this high. And this shows that price is likely to continue bullish. Do you get it? So because you see price is closer to this draw on liquidity, already price has closed above this, so price is going to continue bullish. So we need to go to the 1 hour time frame and look at what the 1 hour time frame is doing. So here, when we come to the 1 hour time frame, we have to also identify a price range. Now, if you look at it, price consolidated and now expand, because price can move from consolidation to expansion. Now, since price expand and now have swift liquidity, you need to wait for a fair value gap, or because price after expanding and reaching a particular point of interest, price can retrace. At this moment, you have to be patient and wait for price direction, because we see now that we have our consolidation during Asian session, and we see during London Open, we see another expansion. So what I'm going to do is now, I'm going to go to 5 minutes time frame and identify a range to see if I can take 30 pips in the market. So here, what do we have? We've seen that price has what? Has created this change in the state of delivery, and price bought at this level. So all we need to do is to look for what? For fair value gap at discount level. We want to see what? We want to see price creating swing low and swing high for market direction. So guys, this is how to easily determine your bias in the market. And also, if you're new to this channel, you can like, subscribe, and follow. I have a free Telegram group where I send setup, and also we discuss setup. So guys, this is all I have today. I wish you happy trading. Bye.